Welcome to the 10-Minute Trading Room, where we take the guesswork out of trading.
Hey there, 10-minute traders. Happy December the 9th to you. How are you? It is great that you're able to meet us here. I have a few things in store for today's trading room. One thing I would like to ask you to do real quick is go over to the chat box, type in, say hi, let me know you're here. Like I said, I have somewhat of a full trading room plan for today. So this one may go long. I'm going to do my best to be respectful of your 10-minute time that we're going to spend together, but it may go long. So again, happy December the 9th. Thank you for joining us here. The first thing that I want to look at is our market analysis. So the S&P continues to be in this range, but we're not trading range bound. We're trading trend following. What I'm excited about is we're finally having a red day, right? After this monster 5% up move that I totally called, by the way, we're seeing this start to break down a little bit. Hopefully, we can see it break down more. And I say hopefully because I'm not a perma bear or perma bull or a perma anything, but I want to go play too. And when you look at the MMFI, this says that we're basically only one out of every three stocks is bullish. The market internals are breaking down. Now we just need to have the market indices reflect this breakdown. The market's up like 24% on the year. It can come down a little bit. And when it does, we are going to be there. We're going to be playing it short. But until then, we are playing defensive. There's three kinds of days: offensive days, defensive days, and transition days. Today's a transition day because we still need the market to confirm which direction it's going to go. One other key aspect I'd like to point out: the last time we were at these levels, where price is at 466, I'll just go ahead and move this bar down so you can see. The difference in the 10-day and the 20-day moving averages was from 463 up to 467. So $4 difference between these two moving averages. Today, that's about 40 cents. That's a really bearish sign right there. Same price, but the difference over the last couple months has really contracted. Hey, we do have some people in the chat. Isaac, hey man, I am glad that you made it. You and I'm glad you were able to watch Victor's interview this morning, and leaving that comment. So thank you for doing that, Isaac. I'm so glad that you're able to make it from Alaska. It's amazing how the internet can connect us, right? The land of the midnight sun. Yeah, I wouldn't be able to handle your rotation with the sun there. That's crazy. But I'm glad you are, and I'm glad you made it today. Luis, hola, senor. Welcome from the Houston area, I believe. And Daryl, hey, I'm glad you made it. I just sent you an email just a second ago, and it looks like you got the link. So perfect. Thank you all for showing up. It means a lot that you can show up and participate live. Like I say, we do have a full episode planned. So let me do this. We talked about MMFI. Let's talk about FinClub real quick. Our artificial intelligence data. This tipped us off last week. I think it was last Thursday or Friday. It was either Thursday or Friday. It came in green on the AI data. While the market was like spitting down hard, they came in green. And I was like, this is a sign. Watch for this. All right. And that's exactly what actually kept us out of a short trade that would have like reversed hard against us. Now we are starting to see the AI data again show more bearish conditions, which is what we want to see. We need to have a confluence of those signals. Actually, hang on. Looks like I closed one of my tabs on accident already. We need to have a confluence of signals where we have the market being bearish, the MMFI being bearish, and then finally FinClub being bearish. And when all three of those line up, that will have this green light or this red light all set up in one direction. And that is the time that we will move. So again, waiting for the market conditions to be right. Now, with that being said, Isaac replied, great interview. Refreshing to see another new trader on your podcast. Yeah, it's really exciting. What I like about Victor, so he and I are going to be working one-on-one for the next 12 weeks. What I liked about Victor was that he wanted to skip the learning curve. I wish I had been that smart because I spent multiple 5 figures figuring out how to trade. I mean, like, to the point where I was like, I cannot believe how much this lesson cost me, but it helped me and I learned a lot from it. And I'm going to profit from it forever because I now know how to not do that thing, whether that case is. So, yeah, exactly. It really is refreshing to hear from him. I kind of wish that I still had some of that like beginner's mindset that he's going to be going through because it does help click things together easier. Anyway, let's get on to the next section. The next section, actually, I'm going to skip because we don't have any new trade setups. We don't have any anything in our portfolio right now as we're playing defensive. We're going to go straight to our member highlight because I do have quite a bit to talk about. All right, so one of our members in the trading room, his name is Kavan. Kavan sent me some of his back tests, and he asked me to review these. And I was like, here's a great time to do this. We're not going to be putting on any trades today, but we can absolutely talk about Kavan's back tests and maybe give some feedback because I know what he's going through. So here he talks about, can you please review the results of this back test on the 8 crossing over the 21? I'd love to find a better exit strategy. All right, to his point exactly. Using moving averages crossovers is awesome for an entry point. Remember we talked in the past about how you can get on anything that's going up. Let's pull up Tesla. You can get on anything that's going from 5 to 100, right? And we don't know where it's going to be. A moving average crossover is really nice because it shows you at what point in time a trend has changed. There's 4 phases of a market. There's phase 1. Give me 2 seconds here. So Brian Shannon, he's been on the podcast before. He runs the website alphatrends.net. He sent me his book, and inside of his book came with a poster, and it talks about the 4 phases of the market. Phase 1 being the sideways, nothing's happening. Phase 2 being the monster growth phase. That's what we're all looking for. That's the uptrend. Phase 3 is the topping phase, and phase 4 is the downtrend after the move has been made. So Mark Minervini talks all about that phase 2. But you can get on at any point in time. It's just the moving averages crossing over. We'll show you basically which phase you're in. If they're crossing up, that's going into phase 2. If they're crossing down, that's going into phase 4, the downtrend. So anyways, getting back to Kavan's question here. I mean, the strategy he picked shows an excellent return, 303.6%. And I really like that. He also back tested it on the 10-day. Remember, just my simple average crossover, the 10, enter over the 10, exit over the 10. His criteria isn't shown here, so I'm not totally sure. Also, I like that his is named Chuck Norris Market Crushing Cyborg as his strategy. Very good. I like that name. And then also he wrote same stock on the 5-day. So like I say, I don't have the total criteria from his screenshots, but we can get an idea of what's going on here. He's asking about mainly the 8-day crossing over the 21, and he wants a better exit point, and I get it. Because if you recall, this is why I brought this out. If you recall, the moving averages are crossing and showing to be bullish on this side of the equation, okay, when we're starting phase 2. The moving averages are going to cross and start to show bearish on this side of the equation, phase 4. So if you're waiting for the moving averages to cross back, you're going to give up a lot of profit. And that's exactly his point there. So I like to see the moving averages all facing a certain direction. Hang on, let me do this. I like to see the moving averages all facing a certain direction, whether that's all bullish, like Tesla stock here, as you can see in this example, Or all bearish. Let me look at a Chinese stock. Or all bearish like this, right? So they're all moving in one direction. I'm not looking for the crossover. I'm looking for all of them. And then once they're all moving in the same direction, I'm now going to follow one line as my exit point. And you can always enter back later. That's a fear that a lot of new traders have, is that they feel that if they've gotten in, the only time that they can get out is the perfect right time to exit. No, not necessarily. Price can bounce around. You can get out and get back in, and you can still play it 3 or 4 times before it actually breaks the other direction that you're trying to avoid. Isaac is asking, are we in phase 3? That's a really good question, Isaac. Let's take a look at that. I'm really impressed with you making that dot right there, that connection. Yeah. So let's make this bigger. Phase 1 is where we are moving sideways. Phase 2 is where the moving averages are crossing over, moving in one direction. Phase 3 is where the moving averages are crossing back. Phase 4 is when they start breaking down. You nailed it, Isaac. Well done. I wish I could send you like a treat or something. That was really good. I'm impressed. So yeah, exactly. That's what we're looking at in the market right now, is we are hitting a phase 3 point, and we need to start seeing a phase 4 to come to play. That's the way I look at it. I don't know if you look at it, but like for me, trading is a game. Trading is a video game. If you think it's anything different than that, you've got to remove your emotions from it. And it's exactly that to me. I'm looking to go play. I'm going to keep my risk really tight. Think of it like Mario. When you're playing Mario and you are going along and you know your character dies, you get hit by one of the turtles there, right? You've only gone so far. You've kept your risk really tight. But the longer you play, the more your skills develop, the further you can go, and the more risk you can take and moving along. So yeah, I feel like hang on, what is this here? I don't know why my emojis don't come through. I wish they did. Someone the other day had clapping hands, but it said washing hands. So anyway, let's go back to Kavan's question here. Let's look for a better exit. So wow, look at Apple. Oh, that was actually something I wanted to talk about. So earlier on in the day, hang on, let me pull up my Twitter. Earlier on in the day, Mark Minervini, if you ever hear me say Mark, that's what I'm talking about. Mark had retweeted somebody who had done the math, and this person has deleted their tweet since then. But he was saying that if you take out the 5 biggest stocks, which are going to have the largest market weight, if you take those out, the Qs are actually QQQ, NASDAQ ETF. The NASDAQ ETF is actually down on the year. When you add those back in, it's up like 20% on the year. And his point was the breadth has gone from this market. I'm not the only one who's noticed this. Isaac, I will dab right there for you sir. You got it. Okay, back to Kavan's point. He's looking at the crossing overs points. But you see how these split as far as they do? That's a very, very bullish sign. If we are to wait for them to come back and go the other direction, cross back down the other direction, he's got to go not only through, we're going to use these 2 lines here, the 10 and 20. He's got to go not only through the blue 10, but he's also then got to go through the black 20 in order to get the 10 to cross down below the 20. That was really complicated sounding. But if you put it on when the moving averages are all pointing in one direction, and then you take it off when you're finding a moving average that provides you a really strong back test, like this may be the 10, it may be the 12, maybe the 15. If you put it on when it crosses below that first line that you're following and you've used your back test on, then you don't have to wait for it to then crash through the second line and then the 2 points to cross. Yeah, moving average crossovers are fantastic entry signals, really poor exit signals, because you have to give up a ton of that profit in order to get your signal. One of those lessons I've learned. So Kevon, my point to you would be keep testing. I love what you're doing, and I'm really impressed that you've taken the initiative to do that. Keep testing, finding what you feel is an appropriate back test. Don't overfit it, right? If it's the 7 and the 21 or the 6.3 and the 20.99, don't overfit it. You want to get the right. You want to make it robust. That's the word everyone talks about when they talk about back tests. You want to make it robust. In a robust back test, it doesn't have to be precise. It can be somewhat fluid, right? Like if it works on the 10, it's going to work on the 9, it's going to work on the 8, it's going to work on the 11, it's going to work on the 12. So don't isolate yourself to just those particular points. Keep testing and finding what works for you. 10-minute trading is all about using that time of research ahead of time. So that way, when it's time to trade, you know what to do in and you know what to do to get out very fast. So yeah, Kevon, nicely done. That was our real member highlight of the day that I really wanted to go through. Kevon, I'm impressed, man. Keep it up. Now on to our final thoughts. This is going to be a good one. Oh, hang on. Sometimes I just can't get it to fit right in my screen. What if I do this? And then zoom in. Oh, that didn't work. Hang on. Let me go back to the other way. Reset. Okay. That's the fun of doing it live. What is the single worst piece of trading advice you have ever received? Do me a favor. In the chat box, let me know. Mine, which this is in the New Traders, Rich Traders Facebook group. This is Steve Burns' group. I don't do much Facebook. If I do, it's here. And so mine was let your losers run. They'll always come back. Remember that webinar I did last week? And I was talking about how my trading gurus would say, probabilities of profits and what are the other things they'd say? Take like crazy risk, right? So to make 100 risk 400 or 600 or 900. And one of the things that they would tell people is, hey, let your losers run because the probability of profit shows that they'll come back. Hang on, pause for dramatic effect. Really? Yeah. No. Oh, Isaac said, buy and hold, adding to losers. That's a really good one. Paul Tudor Jones, one of the greatest traders ever. Well, I'm pretty sure he was a market wizard. I would love to chat with him because he's still doing his thing. He is seen from the 80s. In fact, let me Google it real quick. There's a picture of him, losers, average losers. The picture of him in his office. Here we are. That wasn't hard to find. Where he says, losers, average losers. Dude, I know what you mean. And it's so tempting as well to be like, oh, if I bought it at $5 and now it's down to $4, it's a 20% off sale. I can add more to it. Now my break-even point's down to $4.50 instead of $5. And then when it goes down to $3, oh, I can add more. And now my break-even point's down to $4. And at that point, like that's the clearest sign that your trading plan is broke all to hell. And you got to get out. So yeah, that's a really, really good one there, Isaac. Thank you for sharing that. Louise says, save money in the bank. You will lose it in stocks. The emoji worked on that one. I don't know why. I'm a little conflicted on this one. And I say I'm conflicted because I agree and disagree. I agree. If you don't know what you're doing, this is not the game to be putting your money into. You are better off putting it in just the S&P 500 into an ETF and never touching it again. But if you understand how the game works, you can do exceptionally well. I mean, I'm proof of that. You guys are proof of that for being in here. So yeah, I do agree and I disagree. If you know how to play the game, you're going to be all right. You can do amazing. It's the most lucrative career in the world. If you don't know how to play the game, you will be handing your money to people who do know how to play. So yeah, thank you for that. That was a good one. All right. I know I told you that today might go long, and it did. I really, really wanted to talk about the back test and the phases of the market cycle. Isaac nailed it right on the head because yeah, we are looking at phase 3 going into phase 4 soon, very, very soon. Louise, that's why you're here, man. You are in the right place. I appreciate you being here. So thank you for joining me on today's 10-minute trading room. This is all part of the strategy. We're just lying in wait, waiting for the opportunity. And once the opportunity comes, we'll be on it. We'll be on it hard and fast. And like, I could use a phrase from, Texas idiom, as they would say, flies on cow dookie. I'll keep it polite. But yeah. So yeah, thank you for coming to today's 10-minute trading room. I will see you guys here tomorrow. And if you have any questions, shoot me an email. I'd love to go through some of your questions or concerns on the member highlight like we did today. Other than that, we will talk soon.